Hello, my name is Tyler Vernon, Chief Executive Officer at Biltmore Capital Advisors. I want to introduce Dr. Donald Chambers, Biltmore's Chief Investment Officer. Today, Don's going to talk a little bit about the importance of diversification within a portfolio.
Hi, my name is Don Chambers. I'm Chief Investment Officer at Biltmore Capital Advisors, and I want to talk a little bit about diversification. Economists are famous for saying there's no such thing as a free lunch, but truly diversification is a free lunch. It's something that everybody can do, and everybody can be made better off. You can get a better risk-adjusted return if you're well diversified. I often joke that the three most important things in investments are diversification, diversification, and diversification. So first of all, what do I mean by diversification? Diversification is putting your money in different risky assets. So to see the benefits of diversification, let's just imagine that every asset had an expected return of maybe 8%. If you put all of your money in one asset with an expected return of 8%, the variance, the volatility of your performance around that 8% is going to be huge. But if you put your money in a lot of different assets, all of which have the same 8% expected return, the more assets you can find to invest in, the smaller, the more narrow your divergence or volatility of your portfolio's return will be around that 8%. So that's why I say that diversification is a free lunch. You don't lower your expected return. All you do is you reduce your risk. So why don't more people diversify? Sometimes it's difficult for somebody who's made a lot of money by being poorly diversified, by having most of their money in a single company or a single asset, find it very difficult to diversify because being poorly diversified is what made them wealthy. But diversification is something that should be taken seriously, regardless of whether you've had good investment results in the past or poor investment results in the past. I think there's three main reasons why people tend to stop diversifying once they were diversified. It's difficult to own a well-diversified portfolio because every time you look at your diversified portfolio, you're going to see that the allocation of the portfolio to the most highly performing asset group is rather modest. And one can't help but be human and think, why didn't I have more money in the highly performing asset group? And of course the answer is because you were diversified. You don't put a lot of eggs in any one basket. Similarly, people can look at a diversified portfolio and wonder, why did I have money in this worst performing asset? Couldn't I at least avoid being in the worst performing asset? And the answer, if you're diversified, is no. By definition, when you have a diversified portfolio, at least some of your money will be in very poorly performing assets. That's the joy of diversification. The third reason that some investors stop diversifying is they begin to think that maybe they can turn diversification on and off relative to the market. So in times of crisis, after the losses have been taken, they decide to diversify. And then in times of bull markets, when things get very good, they take less diversification. That tends to lead investors into exactly the wrong strategy, which is that they take more aggressive positions when times are reaching their peak, and they take very conservative positions when times are at their worst.